Welcome to our today's class. We're going to review questions on non-routine decisions on make or buy, and also what we call special offer decisions. So those are what we're going to do. If time allows, we also look at cost bookkeeping or any other area that we had to look at. So we want to look at some questions on make or buy. Make or buy. So it is November 2016, question number 3C. November 2016, question number 3C. We call them non-routine decisions. Non-routine decisions. So the questions, November 2016, question 3C. Make or buy decisions, special offer decision. So November 2016, question number 3C, CPA. This is the question we're going to do. Call them special offer decisions. Special offer decisions. So November 2016, question number 3C. November 2016, number 3C. So the question reads, Rabour Limited manufactures a range of products. So the company absorbed production overheads using a rate of 200% of the direct wages. This rate was calculated from the following budgeted figures. Variable production overhead, 6,400,000. Fixed production cost, 9,600,000. Direct labor cost, 8 million. So the management is faced with the following decisions-making problems. Problem number one, the normal selling price per unit of products ZAM is 220, while the unit production cost is as follows. Raw materials, 80 shillings per unit. Direct labor, 40 shillings per unit. Production overhead, 80 shillings per unit. Total cost, 200 shillings. There's a possibility of supplying a special order of 2,000 units of product ZAM at 160 each. If the order is accepted, the normal budgeted sales will not be affected, and the company has the necessary capacity to produce the additional units. Problem number two, the cost of making component B, which forms part of product Y, is given below. Raw materials, 40 shillings per unit. Direct labor, 80 shillings per unit. Production overheads, 160 shillings per unit. Total, 280 shillings per unit. Component B will be bought from outside supplier for 200 shillings. Fixed production costs will not be affected. Required, Roman 1, advise the management on whether to accept the special order under problem 1. And number 2, evaluate whether the company should continue making component B or buy it from the outside supplier under problem number 2. So here we have two kinds of decisions that are supposed to be made. One is whether they should accept a special offer. So there's a customer who needs 2,000 units of the product they are making. So they want to make a decision on whether to accept. We said under special offer and you're the one being given an offer to supply, you check if you have the capacity to be able to supply the offer. What you check is the offer bringing in some profits? You check the cost of meeting that offer vis-a-vis the revenue that the offer is bringing. If the revenues, provided you have the capacity and the offer is bringing some revenue, you accept the offer. When it comes to making or buying, you check the cost of making, vis-a-vis the cost of buying. And then you compare. Whichever is lower, you pick that one to be. So here we need to list the cost. We need to know the cost of the special offer. So remember when you're making a product, the composition cost is material, labor, and overhead. Those are the component cost of a product. So now you need overhead. We said we absorb overhead. So we need to get the absorption base. We need to get the absorption base. According to this, we need to get the absorption base. Variable production overhead. Production overhead absorption. So here we get the production overhead absorption base, absorption rate. Why do we need this one first? We said overhead we estimate, we call it absorption. The material cost, we're able to tell the costs in advance, isn't it? So when it comes to overhead, you absorb. So in this question that we've been told, overheads, the company absorb production overhead using a rate of 200% of the direct wages. So they absorb using the direct wages. So variable production overheads here. So we're going to write variable production overheads. So the total overhead, variable production cost, the total overhead is 6,400. Can you be able to see? 6,400. That is the total variable production cost. And the total wages is how much? 8,000. So they absorb overhead based on the direct labor cost or direct wages. The production over using a rate of 200% of direct wages. So this is they absorb it using this. When it comes to cost, we said you must multiply by 100. So what would that be percentage? Hmm? 80%. So this one they absorb using 80%. And then variable, that is variable. And then we have fixed. We have fixed production overhead, fixed production overhead. The total is how much? 9,600 over 8,000 times 100. What do you get? So 120. So this one will be 120%. So the total here will be the 200. So that is the breakdown of the 200%. So here we are going to make a profit statement. Profit statement for special offer. So we're going to prepare a profit statement for special offer. A special offer is where there is an organization that is willing that you sell them the product that you are making or selling. So they give you the opportunity to supply them. So we're saying for you now to make that decision, provided you have the capacity to be able to supply, what you consider is the revenue you are getting from the offer, the amount of money that you are getting. So here, they want this company to supply them 2,000 units. They want this company to supply them 2,000 units. Where am I getting that information? In note number. There's a possibility of supplying a special order of 2,000 units. That is the special offer, isn't it? So here we're going to have shillings. So the sales revenue here, the sales will be 2,000 units they require at what price? At 160. So 160. So that is the revenue that they are receiving from the special offer. So that one will give you how much? 3? So this one will give you 320,000. That is the revenue they are receiving from the special offer. Are we together? And then now we less production cost. Production cost here, we less production cost. These units that are going to be supplied, 2,000 units are going to be produced, and they are going to incur costs in the production process. So the first cost here is raw materials. Raw materials. So the raw materials is 2,000 units. Each unit of raw material is how much? 80 shillings. So you're going to multiply this one by 80 in order to get the total cost of the raw material. How much will that be? So this one will be 160,000. You deduct this one. And then there will also be the cost of direct labor. Direct labor, how much is it? Direct labor is 2,000 shillings times 2,000 units times 40 per unit. How much is that? So this one will be 80,000. So you deduct here 80,000. And then there will be variable production overheads. variable production overhead. Variable production overhead, which is 80% of direct wages. Direct wages is how much? 80,000. This 80,000. So that one will give you how much? 64,000. So remember, we have also been told that the fixed production cost will not be affected. In other words, they are not relevant as far as this analysis is concerned. Fixed cost, those ones you still incur irrespective of whether you take this decision or not. So they are not relevant as far as this decision is concerned. So those ones you meet. So you only consider the variable production overheads. So you only consider the variable. We call them marginal cost of production here. And how much you get? So fixed costs are irrelevant since they are not affected by the decision. 16,000. So this one is 16,000. So provided you are making a profit on any special offer and you have the capacity, you accept the offer. So the thing is you accept. So this one you accept this offer because it leads into profitability of 16,000 shillings. So that is special offer decision. Problem number two, the problem is they are facing a decision whether to make a particular product that they are using or to buy it from the external suppliers. So we are going to list down the cost of making B. Cost of making B. Is it B? So cost of making B. So we are going to list down the cost of making. So the cost of making, we have raw materials per unit, that is. We have the raw materials per unit. So raw materials here. So the raw materials per unit is how much? 40 shillings. And then we have direct labor here. Direct labor is how much? 80. And then we have variable overheads, which is 80% of 80. 80% of 80 is how much? 60. So this one will be 64. So that is the cost of, those are the cost of making. You only consider variable cost of making, not fixed. So you add them. What do you get? Sorry? 182. So you get 184 here. And then you compare, this is 184. And then cost of buying cost, you compare with the buying cost. What is the buying cost? The buying cost is 200 shillings, isn't it? So buying is 200. So you need to make a decision between those, either to continue making or. So the company should continue to make B because it is cheaper to make than to buy from the external supplier. So that is how you, tackle questions on special offer and make or buy. Make or buy. So that is special offer, make or buy. Are we together? Any question? Production overhead, we say this, that one is subdivided into two. We have variable component and fixed component. So we are only interested with the variable component. Variable component. The fixed component, it should be eliminated. That is the reason why we had to break down what is a 200% composed of. We had been told earlier on by the question that the production overhead, the manufacturing, the company absorbed production overhead using a rate of 200%. Okay, and this production overhead is subdivided into two. We have fixed and variable. Fixed is not relevant. Even the question has told us. Why are we saying it's not relevant? It will be incurred irrespective of whether you make the decision or not. So it is not used in this analysis. It's not used in this analysis. So these are the very easy question to make, to approach. So that is a total of 12 marks. So we're looking at make or buy. So this one was make or buy decision, or those are make or buy decisions. That is November 2016, question number 3C. So make or buy decisions. So November 2013. So we also want to look at, we're looking at the special decision. I hope you understood that one. So we're also going to look at December 2013, question number 1C. 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 So these are, okay, this one, we're looking at the special decisions. So there are around 4 decisions that you're supposed to make. The first one is what we call this make or buy, this one, special offer, this one we have done. Number 2 is what we call optimal production mix. Production mix decisions, the limiting factor. Although that one appeared last sitting, I'm not sure whether it can also come, but we need to know it, isn't it? So a good example is this one, December 2013, question number 1. So the question reads, question 1C. Question 1C. NEB Limited manufactures 3 products, namely A, B, C, which uses the same inputs but in different quantities. In addition to these inputs, each unit of product C uses component MT200, which the company currently purchases from the external suppliers for 80 shillings per unit. So the following estimated data relates to for the month of January 2014. So we have that demand units you have been given, cost per unit you have been given there, additional information. The monthly fixed cost amounts to 150,000. The company has reverse engineered the component MT200 and has realized that it could make the component in-house at the following cost per unit. Direct materials is 4 shillings per kg. Is it 4 shillings per kg, 12, skilled labor 16, and skilled 3, variable overheads 6. In the month of January 2014, the maximum availability of skilled labor is for 5,400 hours, and all others resources are readily available. So there will be, number 4, there will be no incremental fixed cost incurred as a result of making the component in-house. Number 5, the company bases all short-term decision on profit maximization. Number 6, the company will either buy the component or make it in-house. It will not use mixture of the components required. Advise the manager of NEB Limited on the optimal production plan for the month of January 2014. So this is now the optimal production plan arises where we have a limitation of a particular resource. So all the units that are demanded cannot be produced. So we need to now to have a mixture that will maximize profitability. So we need to determine which products we're going to be supplied as per demand, and which one was going to be supplied in not as per the demand. So we said this one has a procedure. This one has a procedure.